Money is everywhere in your life. It decides where you live, what you eat, how stressed you feel at night, and yet, most people never stop to ask one simple question. Why do smart people make terrible money decisions? Why do people who understand finance still lose money, while others with very little knowledge quietly build wealth? And what if the real secret to money has nothing to do with intelligence, math, or luck, but everything to do with how you think and behave? If you stay until the end of this video, your relationship with money will change. Not because you learned a new strategy, but because you finally understand how money actually works in the real world. This is The Psychology of Money by Morgan Housel, and this book is not about how to get rich fast. It is about how to stay sane, patient, and successful with money for a lifetime. Take a breath, and let us begin. Most people believe money is about knowledge. They think the smartest investor wins. They think the person with the most information makes the best decisions. But Morgan Housel starts with a different idea. Money is not a math problem. Money is a behavior problem. Two people can earn the same income, read the same books, and invest in the same assets. One builds wealth, the other struggles forever. Why? Because they behave differently. Think about this. How many times have you known what the right decision was, but still done the opposite? You knew you should save, but you spent. You knew you should stay calm, but you panicked. You knew you should think long-term, but emotions took control. That is not a lack of intelligence. That is human psychology. And money is deeply emotional. Your money decisions are shaped by fear, ego, greed, pride, insecurity, and comparison, not spreadsheets. This is why traditional financial advice often fails. It assumes people are rational. But people are not spreadsheets. They are emotional beings with stories, experiences, and biases, and that changes everything. Everyone views money through their own personal lens. Your view of money is shaped by where you grew up, what your parents experienced, what you saw during childhood. Someone who grew up during a financial crisis sees risk differently than someone who grew up during a booming economy. Someone who watched their family lose everything will value security more than growth. Someone who never experienced hardship may take risks without fear. None of them are wrong, they're just different. And this explains why people argue endlessly about money. One person says investing is dangerous. Another says it is the only way forward. One person says saving cash is smart. Another says it is foolish. They are not arguing about facts. They are arguing about life experiences. Understanding this makes you calmer. It makes you less judgmental, and more importantly, it helps you design a financial life that fits you, not someone else. Because the best financial plan is not the one with the highest return, it is the one you can stick with. One of the most powerful ideas in this book is simple. Doing well with money has little to do with how smart you are, and everything to do with how you behave. Behavior matters more than knowledge. You can be brilliant and still fail if you panic at the wrong time. You can be average and succeed if you stay patient and disciplined. Think about investing. Most people know the basics. Save consistently, invest long-term, avoid emotional decisions. The problem is not knowledge. The problem is behavior during stress. When markets fall, fear takes over. When markets rise, greed appears. People buy high because they fear missing out. They sell low because they fear losing more. Not because they do not understand investing, but because emotions overpower logic. The greatest investors are not those with the highest IQ. They are the ones who control their behavior when emotions are loud. Calm beats clever. Always. Now pause for a moment and ask yourself this honestly. How often do short-term emotions control your long-term financial decisions? Not once, not occasionally, but consistently. Fear is powerful, excitement is powerful, and both are dangerous when money is involved. Fear makes you protect yourself too early. Excitement makes you chase things too late. Short-term thinking feels natural. Your brain is wired for it. Every day, markets move. Every hour, headlines scream. Every minute, social media pushes urgency into your mind. Someone is getting rich. Someone is losing everything. Someone has discovered the next big opportunity, and your brain reacts automatically. Your heart rate changes. Your confidence shifts. Your patience disappears. Not because you are weak, but because you are human. The problem is not emotion itself. The problem is letting emotion drive decisions meant for decades. Because wealth is not built loudly, it is built quietly. It is not built in a rush, it is built slowly. It is not built through constant action, it is built through restraint. Years matter more than days. Decades matter more than months. And yet, most people live financially as if today is all that exists. The ability to ignore short-term noise is one of the rarest skills in the modern world. It is not taught in school. It is not rewarded socially. It does not look impressive. But it works. Long-term thinking means accepting discomfort today for freedom tomorrow. It means staying invested when fear tells you to escape. It means staying patient when excitement tells you to act. Volatility is not a sign that something is broken. Volatility is the price of admission. If you want growth, uncertainty is unavoidable. If you want returns, discomfort is part of the deal. The mistake most people make is believing that progress should feel good all the time. It does not. Progress often feels boring, uncomfortable, slow, and boredom is not failure. Boredom is stability. Patience outperforms brilliance far more often than people want to admit. The hardest part of investing is not finding the right strategy, it is sticking with a reasonable one when emotions push you away. The people who master this skill do not look exciting. They do not chase trends. They do not react to every headline. They do not constantly change direction. They look boring, and boring works. Now let us talk about one of the most powerful and freeing ideas in The Psychology of Money, the idea of enough. Enough is not a number. It is not a goalpost you reach and stop. Enough is a mindset. Most people never feel satisfied because they are measuring themselves against others, and comparison has no finish line. There will always be someone richer, someone younger, someone faster, someone luckier. If your happiness depends on being ahead of others, peace will always be out of reach. Chasing endless comparison pushes people into unnecessary risk. People who already have enough lose everything by reaching for more without purpose. They trade contentment for ego, security for status, and often they don't even realize it. Knowing when you have enough is not about giving up ambition, it's about protecting what matters. Enough gives you boundaries. Enough gives you control. Enough allows you to enjoy wealth instead of being owned by it. Money is meant to reduce stress, not multiply it. Money is meant to give you options, not trap you in endless wanting. True wealth is not about what you show, it is about what you control. Time, choices, peace of mind. If money allows you to wake up without fear, make decisions without panic, and live life on your own terms, you are rich, even if nobody applauds, even if nobody notices. Now consider this surprising truth. People with less knowledge often outperform experts. Not always, but often enough to matter. Why does this happen? Experts tend to overthink. They trade too frequently. They chase precision in a world ruled by uncertainty. They confuse activity with progress. Meanwhile, simple strategies quietly win. A basic plan followed for decades beats a complex plan abandoned during stress. The difference is not intelligence, it is endurance. Confidence is useful, but overconfidence is dangerous. The moment knowledge turns into arrogance, mistakes multiply. Sometimes knowing less means interfering less, and interfering less often leads to better outcomes. Simplicity survives chaos, complexity breaks under pressure. At its core, the psychology of money is not really about money, it's about behavior. It's about patience when fear is loud, humility when success arrives, self-awareness when temptation appears. Money does not change who you are, it reveals who you are. If you are impulsive, money amplifies impulse. If you are patient, money rewards patience. Your financial future is not shaped by one perfect decision. It's shaped by thousands of ordinary decisions repeated consistently. You don't need to be flawless, you need to be reasonable. Reasonable people survive market cycles. Reasonable people recover from mistakes. Reasonable people sleep well at night. And survival is underrated, because survival allows compounding to do its work. Before we finish, reflect deeply on this. Are your financial decisions driven by fear or clarity, by comparison or purpose, by short-term emotion or long-term vision? Every financial decision carries a psychological fingerprint. Change the way you think about money, and money changes the way it behaves in your life. Not instantly, but permanently. If this video helped you see money differently, support the channel by liking this video and subscribing for more deep lessons on investing, psychology, and financial freedom. Comment below the biggest lesson you're taking away from the psychology of money. Your insight may help someone else shift their perspective. And in the next video, we'll explore how great investors think during chaos, why calm always wins, and how patience quietly builds fortunes. Until then, think long-term, stay patient, and respect the power of psychology.